He is Chris Toomey, Morgan Stanley Private Wealth, joining us once again. So you're as cautious as you have been, or are you easing up a little bit?
No, we remain cautious. I mean, I think from our standpoint, the last time we were here, we were a little concerned about how oversold the market was. We got one, what I would say, better than expected print with regards to CPI and PPI, and that was the trigger, right? So it wasn't necessarily a good print. It was better than what the market was expected, and now we know how offsides the market was, right? So in our estimation, we thought about $250 billion had to be bought to get back on side. And if you look at it, about the highest shorted names were up about 25% over 2 days. Mm-hmm. So that's kind of the market resetting after being so oversold. And now I think we've gotten through the earnings period. We're starting to look into next year.
Are you still raising cash on rallies as much as you were, or is that sort of dwindling down?
It's kind of dwindling down. I mean, from our standpoint, we're pretty much in a defensive position with regards to equities. I think the area that we're probably raising cash from now is probably in our non-traditional parts of the portfolio. So we've done really well in real estate over the last 2 or 3 years. You know, if you look at the yields there, they're not as attractive as they once were. And then we've got a situation where pricing is a little bit higher than we would like. And on the flip side of that, we're seeing some real opportunities in traditional fixed income. So we're starting to roll some of that money into traditional fixed income.
I mean, the house view at Morgan Stanley is, even from the most negative around, at least from Mike Wilson, is that you have some legs here potentially. You could get to 4,100, if not beyond, which is the top of his range. And as I'm saying that, it sounds like you don't necessarily agree.
No, I mean, I think you could see it. I think we're at a really tricky part of the cycle right now where we've moved from focusing purely on the Fed to really starting to focus in on the effects of the Fed. So I think if you look at our view, I think the real focus now into 2023 is going to be on earnings. And earnings right now are way too high. So if you look at...
They're still too high, even though they've come down a bunch for next year.
No, and they're going to come down even more. So as we get into the end of the year, you'll see strategists and economists starting to ratchet down their numbers so they don't look as bad as they were. And in that situation, what you're going to see is people coming to the realization that next year is going to be really tough.
Well, that's his view, too. It's like, OK, you could get a nice move between now and the end of the year. I mean, you could do the 4,100, as I said. Maybe you overshoot that a bit, but you get a real reality check next year when earnings slap you in the face and you realize they do have to come down further. But you're not even playing for the short game?
Not really. I mean, look, we have some active exposure. We've got some exposure to hedge funds that are going to be a little bit more tactical. But from our standpoint, the risk is really to the downside, and the pain is going to be even more so than the market's pricing in right now. So it's not really worth the risk to try and time this perfectly.
So what about crypto? I'm curious as to sort of what the private wealth world has done with it for their clients. Did you put any of your clients in it? If so, how much? Would you? What's the deal?
No, I think from our standpoint, look, crypto is obviously something we've paid attention to. We've got clients that are actively involved in it, but it's not necessarily something that we've recommended or had a view on. Ironically, every time I've gotten the urge to look more into crypto, it's sold off dramatically. So I was going to read over the summer up on crypto. We saw the huge flush out, and then I got a book at a conference, and I started reading on it, and we just had FTX go under. So the more I read into it, the more the market seems to not like it.
Do you have any concerns, sort of, like the ones we heard early in the show? I'm not sure you heard of about a broader market event as a result?
Look, I think that's a real concern. I think when you see these types of moves, whether it's crypto or with regards to rates, I think the real concern is what the second derivative effect is, right? So you saw a situation, I think London's a particularly good example where, you had rates gapping out and then you had a real problem within UK pensions, right? And so I think that's something that we're always very concerned about. And to your earlier point, maybe the S&P 500 goes up to 4,100, but there's a lot of things that we're concerned about that we don't think are necessarily priced into the market.
So you can't be positive at all until the Fed eventually makes its pivot. How are you going to know when earnings bottom? I mean, how are you going to know?
I think it's going to depend on price, right? So I think what's going to happen is you're going to see a situation where we're already seeing consumer savings drying up. We've seen consumer debt starting to pile up, particularly within credit card debt, which is very, very expensive right now. There's concerns with regards to housing The Dallas Fed just came out and said they're assuming a potential for 20% pullback in housing prices. So all that's going to affect the consumer. And I think what you're going to start to see as we start talking about fourth quarter earnings, you're going to start to see, as we talked about, what's the guidance going forward? What's the guidance going on into 2023? And I think particularly around the holiday season, where you see a tremendous amount of consumer spending, and to Josh's earlier point, we're at a situation where the supply chain has opened up. You've got more and more goods coming in, but demand is starting to come down. And that's going to have a real effect to earnings. And I think the question is when do companies start capitulating with regards to guidance, which is going to start to pull earnings down?
All right. Thanks for coming in.
Thanks for having us.
We'll see you at the stock exchange, I think, next time. It's Chris Toomey.